Imagine an American tourist packs his bags for an international tour. In his wallet, he carries a single US dollar bill. He lands in Germany, goes to an exchange booth, and watches that dollar collapse to just 90 euro cents. Confused, he flies to Vietnam, hands over that exact same piece of paper, and receives a massive stack of 25,000 Vietnamese dong. Curious, why does the exact same piece of paper hold drastically shifting valuations across international borders? And why do these invisible exchange rates fluctuate with unpredictable, violent movements every single microsecond? In global macroeconomics, international currency values act as a live scoreboard of geopolitical dominance, central bank warfare, and hidden capital manipulation. To understand why paper money commands shifting values, we have to look at monetary history. For generations, currency held physical boundaries because it was anchored directly to fixed weights of precious assets, specifically gold. A nation's paper currency was a secure legal receipt backed by physical gold locked deep inside institutional vaults. In the 1970s, the United States officially tore up that ledger, and the entire global infrastructure transitioned into the era of fiat money. Today, fiat money holds zero physical backing and zero intrinsic value. It is legal tender because a centralized government issues a decree declaring it has value, and the population maintains a psychological belief in that authority. It is an unbacked system operating entirely on the mechanics of supply, demand, and global confidence in a nation's productive output. The math here is unforgiving. If a government destroys its domestic economy, the global market will aggressively dump its currency on the open exchange. In Venezuela, the local bolivar became worthless because nobody wanted to hold an asset losing value by the hour. This leads us to the first violent lever of currency valuation: inflation. At its core, inflation is a silent tax. It manifests when a centralized system prints unbacked money faster than the physical domestic output of products and services. Zimbabwe provides the mechanical case study for this failure. In the early 1980s, the Zimbabwean dollar traded at a premium value against the US dollar. But following structural economic collapses, the state resorted to hyper-accelerated money printing to clear its debts. By the turn of the 2000s, the currency completely dissolved. The central authorities attempted to mask the destruction by executing currency rebasing tricks, slashing zeros off the physical notes. But the global market saw through the illusion. Ultimately, unchecked inflation breaks the social contract. It creates a scenario so toxic that the domestic population is forced to abandon their own sovereign currency and adopt stable foreign assets to survive. Beyond inflation indices, international capital flows are dictated by interest rates. These represent the absolute cost of borrowing capital, calculated as a strict annual percentage, and they are controlled by central banking institutions like the Federal Reserve. Make no mistake, this is a strategic offensive maneuver. When a central bank hikes its interest rates, it immediately offers higher yields on domestic investments. This turns the nation into a high-return liquidity trap for global investors seeking premium bond yields. To capture these high premium yields, international funds must first liquidate their home currencies. They rapidly execute market orders to buy the host nation's currency, sparking a global demand wave that skyrockets its valuation on the international exchange. But pushing these yield rates too high acts as a double-edged sword. High interest rates make domestic consumer debt, mortgages, and commercial business loans unsustainably expensive. If borrowing costs skyrocket, citizens stop purchasing homes and enterprises freeze expansion plans. This is why the global financial elite hold their breath whenever the Federal Reserve Chairman steps to the podium to announce rate adjustments. It is a primary lever of global wealth distribution. Macroeconomic trade flows and geopolitical agreements can structurally force the globe to buy specific currencies. Consider the petrodollar system. The United States engineered a geopolitical agreement with oil-producing nations to price and settle global crude oil transactions exclusively in US dollars. Because every single industrial economy on the planet demands oil to function, every nation was forced to stockpile reserves of US dollars simply to survive and buy fuel. Now, contrast this superpower strategy with small, isolated island nations. Places like Tuvalu possess zero global exports to leverage. Their localized currencies hold zero transactional utility for international buyers. To survive, they bypass open market exchange rates using the fixed peg protocol. By locking their domestic currency at a permanent 1-to-1 ratio with a foreign superpower's currency, they ensure absolute, frictionless cross-border trade without consulting a live exchange ticker. But this stability comes at a geopolitical price. The smaller nation surrenders its independent monetary sovereignty. By pegging their currency, their economic survival is tethered directly to the macroeconomic health of the host nation. This complex global friction often begs a question: why doesn't the human race simply eliminate exchange rates and adopt a unified single world dollar? While it sounds elegant in theory, the structural execution is an economic minefield. The real-world experiment of the Eurozone reveals a structural flaw. Every individual sovereign nation must surrender its monetary control to a single centralized entity. When Greece imploded into a sovereign debt crisis in 2009, they were physically blocked from devaluing their own currency to spark a domestic recovery. They had surrendered that lever. Consequently, their localized financial toxicity threatened to fracture the entire European system. If the entire planet adopted one single currency, a local financial error executed thousands of miles away would trigger an automated economic shockwave across every household on Earth. Having the highest value currency on Earth is not always the optimal economic strategy. Different nations require completely different strategic parameters. A nation heavily reliant on foreign imports, like Singapore, demands a strong premium currency. They need that buying power to keep the cost of incoming raw materials and food cheap. On the flip side, an export empire like China frequently prefers a strategically weaker currency on the international market. A lower-valued yuan makes Chinese manufactured products phenomenally cheaper and more competitive for international buyers. This makes their industrial output more competitive, a protectionist maneuver known as the doctrine of competitive currency devaluation. The global currency market operates as a continuous arena of geopolitical leverage, debt protection, and hidden wealth extraction. To protect your assets, you have to master these mechanics. Drop your thoughts on the global currency shift in the comments below. Hit that subscribe button to join our network of capital allocators, and I will see you in the next breakdown.